Today, we're going to be talking about essential concepts using the option Greeks. Now, before we get started, I need to point out options are not for everyone. You should read characteristics and risks of standardized options before trading. Get a copy of that by emailing investor services at theocc.com. All right. So for those of you who are not familiar with me, my name's Dan Passarelli. I am an author of some trading books. I am a trader myself. I've been a professional trader on the CBOE, and I trade my personal account now. I'm the founder and president and CEO of Market Taker Mentoring, the global leader in option trader education. And I collaborate with lots of folks in the trading industry, especially the options industry, most of the exchanges worldwide, as well as many of the brokerage firms as well. And I'm a family man. I have two grown kids, my wife, Kathleen, my two kids, Sam and Isabel. And things I like to do for fun besides trading are I'm a runner. I love to eat. And I am a traveler and also a musician. Okay, so we're going to talk today about the single most important metric when it comes to controlling your risk as a trader and developing reasonable expectations as a trader. We're going to talk about the option Greeks: delta, gamma, theta, vega, and rho. Now, we're going to spend a good 45 minutes to an hour talking about this. I'm going to hold all questions until the end, but if you have questions, I do want to hear them. And so make sure you stay until the end. And also make sure you save those questions until the end, and I'm going to answer them as well as I can. Now, because we're going to spend about 45 minutes talking about the Greeks today, I'd like to give you some further study afterwards. So I'm going to give you a free gift. It's a quick reference guide that I wrote on the option Greeks. You can get that at markettaker.com/QRG. That's quick reference guide. Or you can just use this QR code here. Just take out your cell phone and go to the camera app, hover over it, and a little bubble will pop up, and you just click on that, and you just put in the email for us to send it to, and we'd love to send you this free gift. All right, so let's jump into this then. The first thing we want to talk about is delta. Delta is it's kind of the king of the Greeks. It is the most important one because most of the risk and or reward that you have will be affected by delta. Delta measures the directional sensitivity of an option's value relative to the stock price. So basically, like, if you know anything about options yet, and if you don't, if you're brand new, that's okay. You're still in the right place. In fact, you're going to get fast tracked, and you're going to be able to learn things a lot faster than others if this is your first exposure. But if you do know something about options, the one thing you know is that if you buy a call, and if the stock goes up, you make money on your call. If the stock goes down, you lose money on your call. And just the opposite for puts, right? If I buy a put and the stock goes down, I make money. If the stock goes up, I lose money. Now, we know this intuitively, but we don't trade options intuitively. I mean, we try not to. And we don't trade them loosey-goosey or right-brained or qualitatively. Like, we can't go to our broker and say, hey, I bought calls and the stock went up, send me a check for something. I don't know, whatever it is I made, send me a check. That's not how it works. When it comes to trading, we need to measure things very, very specifically. This is what helps us to set targets and to set stop losses and to set entry points, being very specific and left-brained is very important when it comes to option trading. So we're not just concerned about, okay, I buy a call, the stock goes up, I made money. I need to know how much I made. And if the stock goes against me, I need to know how much I lose. And that is what delta measures. Delta, if you think about it, is effectively a measure of both leverage and protection. And you can get both when it comes to options, right? Calls are cheaper than buying the stock. I could buy a bunch of calls and have a bunch of leverage, which is great if it works out and not so great if it doesn't work out. If I use delta, I can help find that sweet spot, that perfect balance of how much am I actually risking here? How much do I stand to make? Oh, that's a lot, but maybe I should cut my risk. And it's a measure of protection. I believe I mentioned this last time, but I want to mention it again. We think about puts as insurance policies, right? That's what we talked about when we talked about the collars presentation. And if you didn't see the collars presentation, please go back and watch that one. Right now would be a really great time to watch that one. But puts aren't the only insurance, the only protection. Calls can be thought of as protection too. I mean, look, right now might be a good time to get in the market and buy a dip. But then again, it might not. There could be a lot more downside ahead of us. If for those of you who are watching this live at the beginning of August 2024. Well, if that's the case, we want to be able to put on a position has less risk than buying shares of the underlying. One thing I can do is instead of buying shares of the underlying, I could buy a call. A call is an insurance policy that protects us against being out of the market, right? If you want to get kind of philosophical and think of, you think of stocks and ETFs as an asset, equity as an asset, but cash is an asset too. And we have to choose between those two assets. And whichever we choose, there's an opportunity cost. One's going to be better than the other. When the market's very volatile, we might want to sit in cash. But if we sit in cash and the market goes up a lot, we missed out. Well, calls enable us to hedge against that situation. But how many calls do we buy? Do we buy one? Do we buy as many as we can afford? Probably neither of those two things. This is what we use delta for. Now, I want to get a little bit more specific here about what delta is. And my book, I said I was an author. The first book that I wrote is called Trading Option Greeks, which is all on the Greeks, which is available on Amazon. And in Trading Option Greeks, I list 4 definitions of delta, and these are them. Delta is the rate of change of an option value relative to a change in the underlying stock price. And I could be talking about an ETF, or I could be talking about even a bond or a future or something like that. And it's stated in terms of dollars. And well, actually, it's stated in terms of a percent, really, if you think about it. If the delta is 43, what that means is that that option moves 43% as much as the underlying shares. So if I buy a call and the stock goes up by $1, the call would go up by 43% of $1, which is 43 cents. Same thing if it goes down $1, I lose 43 cents. Puts, of course, have a negative delta. If the stock goes up by $1 and let's say the put has a 57 delta, I would lose 57 cents. But if the stock goes down by $1, I would make 57 cents. That's definition 1. Definition 2 is delta is the derivative of the graph of an option's value relative to the stock price. Now, it may be a while since you took calculus. If you ever did take calculus, calculus is one of those really intimidating bits of math. So maybe you didn't take it. I did take it, but I kind of forget a lot of it, TBH. But really what all that definition 2 is it's just a restatement of definition 1. It basically says the same thing. I like to call definition 1 the textbook definition. I like to call definition 2 the math nerd definition. And I apologize for the math nerds out there. Believe me, I'm sure I got you covered on nerdiness. I got I'm a food nerd and music nerd and, options nerd to boot. But yeah, and definition 2 is for the mathematically inclined, and it just restates the first thing. Definition 3 is delta is the equivalent of underlying shares represented by an option. Now that is the practical definition. And if you think about it, that is also a restatement of definition 1, but it's very, very useful, and it's the prime way that you should think about delta. So let's go back to this hypothetical example. I buy a call that has a 43 delta. That means it moves 43% as much as the underlying. Okay, the underlying goes up by $1. The call goes up by 43 cents. All right, we already established that. But what does that really mean? That means if the stock goes up by $1 and I own 100 shares, I make $100. But if stock goes up by $1 on this 43 delta call, I make $43. So that's like I own 43 shares, right? If I bought 43 shares of a stock, and that stock goes up by $1, I'd make $43, right? So that ends up becoming an extremely useful definition for me to be able to control my risk with. Now, definition 4, I call the trader's definition. And before we talk about it, I got a little note here. Please note that that definition 4 is not necessarily mathematically correct. This trader's definition is included because many traders use it as a rule of thumb, and this is what it is. It's the estimate of the likelihood of an option expiring in the money. Okay, so let's go back to our perennial example. I own a call, it has a 43 delta. What that means is, the way I should think about it is, that call has a 43% chance of being in the money at expiration. Okay? 43% chance of being in the money at expiration. Now, this is not necessarily mathematically correct for various numbers of reasons that I don't want to get real deep into right now, or this will be a really long webinar. But all traders use this as a nice loose rule of thumb. In fact, I can remember when I was a young man on the trading floor, I was a clerk even at this time, and I'd be talking to some of the other clerks and it'd be like, hey, are you going over to Joe's party on Friday night? And I'd be like, it's a 50 delta. I don't know. I might have to take my car into the, mechanic or whatever. 50 delta, 50% chance. Just really ingrained in the trader vernacular. Okay, now let's talk about that rule of thumb. So options that are in the money have greater than a 50 delta. Options that are at the money have about a 50 delta, and options that are out of the money have less than a 50 delta. So that actually fits really, really nicely into that trader's definition, if you think about it. if an option is already in the money, say it's the 90 strike call and the stock is at 100, well, it's already in the money. It's got better than a 50% chance of being in the money at expiration. If you think about stock prices as a probability curve, all right. Now this, again, this is like a higher mathematical thing. And I know everybody comes from different backgrounds. Some people took a lot of math in college. Some people didn't go to college. Some people, have a liberal arts degree and wanted to avoid math like the plague and took a lot of history and such, right? Everybody has a different background. But if you've ever heard of, and I know you've heard of this, a bell curve, right? What's a bell curve? A bell curve basically says, most things happen like, towards the center, and like there's like big moves, big changes are less likely than small changes. If you took a graduating class of 8th graders, right? Most of them would be, I don't know, how tall is the average 8th grader? Well, however tall the average 8th, it's been a while since my kids were in 8th grade. However tall the average 8th grader is, most of the 8th graders are about that tall. But you have one that's really super tall, star of the basketball team. You have one that's really, really short, vertically challenged, that's normal. But most are close to that average height. And then as we get further away from the average height, there's fewer and fewer people who are either really tall or really not tall. Professors think that stocks are priced like this as well. And if you look at a stock chart, it's true. Go back over the past year and you'll see long stretches of periods where the stock, any given stock, doesn't really move a lot from yesterday's close. Small changes. But then you get to some periods where there's a lot of big gaps and choppiness and a lot of moving around, right? So instead of a bell curve, professors call it a log normal distribution. And that's only because that's for a couple of reasons. One is there's a little bit of a bias to the upside because of the interest rate. And two, stocks can't go below zero. And so there's definitely a bias that stock prices can only go so low. So all of that being said, if there's an option that's already in the money, it's already got a head start. It's already on the in the money parts of that bell curve. It would have to make a pretty, it would have to make a much more powerful move to become out of the money. Go to the other side of that. If there's a option that's trading, or if there's a call that's the 110 strike call and the stock is at 100, well, that call is out of the money by $10. And so it's already got a head start of being out of the money. It's got less than a 50% chance of being in the money at expiration because something's got to happen to change that. And then at the money options, they're kind of 50-50. It's right now it's at the money. The stock could go up, the stock could go down. Which one is it going to be? I mean, I don't know. Obviously, we have technical tools that can help us figure that out, that the professors who come up with this log normal distribution business, some of them don't believe that those things are true, and some of them do. Now, there is a bias, and this actually, I'm going to ask you a question. And this is a question where you get to shine. If you know the answer to this question, I'm going to know that you're a little more advanced than the typical trader. So it's your chance to show off. Here is my question. My question is, if there is a call that has, say, 60 days until expiration, and it is exactly at the money, does that call have more or less than a 50 delta? Is that call's delta higher than 50 or lower than 50? I want you to hit that questions box and let me know. Hit the questions box and throw in a guess. If you don't know for sure the answer, that's okay. We all got to start somewhere. If there's 60 days until expiration and there's a stock that's at, say, 100, exactly at 100, we're talking about the 100 strike call, will that call have greater or less than a 50 delta? Hit the questions box. Yes, well, Peter, it is at the money, but my specific question, right, right. It is exactly at the money. So would the delta be, what would it be? Would it be exactly 50? Would it be more than 50 or would it be less than 50? Those are your choices, A, B, or C. All right, Chirag says 50. Scott says more than 50. Anybody say less than 50? We could have a battle royale, three-way cage match. Battle it out. Anybody say less than 50? Anybody agree with either of those two folks? Well, I'm going to give you the answer. So the answer is, it depends. But generally speaking, and almost always, the exactly at the money call is going to have a delta greater than 50%. Now, I kind of like actually alluded to this earlier. It has to do with the interest rate. Because if you think about it, if there's 60 days until, and that's why I gave a specific amount of time, if there's 60 days until expiration, and you can, a company can like start out, raise $1 million and put that $1 million into a CD or a treasury bond or something and earn 5%. Well, over the next 60 days, that company is going to be worth 2/12 of 5% more. So the value of the company is expected to be worth more if like nothing happens. Now, if the company, employs its capital well and does a good job at building quality products and selling them at a good value and building a good business, well, they're going to make more than the risk-free interest rate. They're going to make more. So it's the theory is that companies will be worth more in the future. So therefore, an at-the-money option that has more than a day until expiration is going to have a delta greater than 50%. See, I told you I was a big math nerd, or not math nerd, but options nerd. And I love this stuff. I just love it. So these are some all very useful rules of thumb too. Like, what does this actually mean? Well, look, first of all, you don't even have to know the exact delta of anything. You just know that if the option is in the money, it's going to move more in lock and step with the stock. If the option is out of the money, it's not going to move as much as in the money. Boom, like all of a sudden, really useful information. Now, the call and the put that have the same strike on the same underlying in the same expiration have a relationship. The absolute value of the call delta plus the absolute value of the put delta equals about 100. Now, when I say absolute delta, this is another one of those nerd things, math nerd things that you have to try and remember back from algebra or whatever. Absolute value means we take away the plus sign, we take away the negative sign, and that's the absolute value. And that's important because remember I said that puts have negative deltas, inversely related deltas. So if the call has a 43 delta, the put that has the same strike on the same underlying in the same expiration, if the call is a 43 delta, the put would have a 57 delta. 43 plus 57 is 100. Now, the reason for this is something called put-call parity, which we don't have quite enough time to get into today. But put-call parity is a long-standing mathematical formula that compares the price of a call to the price of a put, including the price of the underlying, and mathematically equates them. Now, when I say about 100, if we were talking about just European options, it would be a lot closer to 100. But with American options, because you can get early exercise, there are like puts that are very deep in the money. They become exercises early, and so their deltas tend closer to 100, and so that's going to throw off the put call parity. If there's a dividend that's coming up, that's going to make the call more likely to be an exercise, and that's going to make the call delta closer to 100. That's going to throw off put call parity. But like, all you really have to know is that when you add up the call and the put delta, take away the negative signs, it's going to be pretty close to 100. And that helps us with things like, remember I said before, hey, if I'm afraid that the market's volatile and I kind of want to get in here, but I'm nervous, I could just buy a call. Yes, but you could also buy the stock and buy a put. And put call parity says that buying stock and a put is mathematically identical to buying the call. Those are synthetic relationships, which are sort of a postulate, if you will, of put call parity. All right. So, when we look in an option chain, we don't necessarily have to have the Greeks listed out. We don't have to have all the deltas or anything. All we really need to have is the option chain itself. And Firstrade does a good job in like changing the colors here. Like Apple, at the time I took this screenshot, was somewhere above 215 and below 220. So all these calls, 215 and lower, these are in the money, so they're yellowish. 220 and above are out of the money, so they're whitish. And then the opposite for the puts. These are in the money, these are out of the money. So what does that help you know? Well, these ones in yellow, they're going to move more lock and step with the underlying. The ones that are in white are going to move less than the underlying. So you can actually kind of get more leverage with these out of the money ones. If it costs me over $12 to buy the 210 calls, I mean, I could buy 4 of the 230 calls. All right. There's so many things we could talk about with the Greeks. I guess that's why I wrote a book on it. And don't forget to grab that quick reference guide as well. I'll just show that one more time. markettaker.com/QRG, or snap that QR code right there. And that's going to cover the things that we talked about today and some more things as well. Okay, gamma. So the thing about delta is that it's not fixed, because the more in the money an option is, the bigger its delta. The biggest a delta can get on a single option is 100, where it acts 100% like the underlying stock. If it's very deep in the money, that's what it is. The lowest the delta can get is 0. If it's so out of the money that like it doesn't matter, it's unlikely to ever be in the money, it'll have a delta of 0, and it'll be like 0 bid at a nickel. And if the stock moves $1, it'll still be 0 bid at a nickel. The price won't change. But if the price changes a lot, and especially for at the money, or just a little out of the money, a little in the money, when the underlying moves, they get more in or out of the money. So naturally, the delta changes. And we can measure that with gamma. Gamma is the rate of change of an option's delta relative to a change in the price of the underlying security. And it's stated in terms of deltas. If the gamma is, 0.16, that means if the underlying stock goes up by $1, delta gets bigger by 16 deltas. Goes down $1, gets smaller by 16 deltas. Now, delta is the biggest for short-term at-the-money options. Gamma is biggest for short-term at-the-money options. When there's like a day or two to expiration, gamma is really huge because, you think about it. If today's expiration day and the stock is, and like say there's 10 minutes until expiration, the stock's at 100, or yeah, the stock's at 100, I own the 99 calls. Okay, if there's 10 minutes to go until expiration, it'd have to move 1% in order to not be in the money. I mean, the delta is going to be like close to 100. But what if it does fall by $1.50? Can happen. Anybody who's traded a long time has seen things like that happen, right? And if it does, it would go from almost 100 delta to almost a 0 delta. That's gamma. So when there's a little bit of time till expiration, it really intensifies. If there's a year till expiration and the underlying moves $1.50, the delta's barely going to change at all. Long options have positive gamma, and positive gamma always helps us. Our delta moves in our favor when we have positive gamma. If we have short options, we have negative gamma, and negative gamma always hurts us. Gamma always moves adversely when we have short options. And, just like think about that. If I have a call, like an at-the-money call with close to a 50 delta, if the stock goes up by a lot, now the call's deep in the money. Now it has 100 delta. So I make money I make money not just at a steady rate, but at an increasing rate with calls. And if the stock goes down, I lose money with calls, but I have limited loss. So I lose less and less as the stock falls because my delta gets smaller and smaller. For those of you who sell naked or cash secured puts, you can only make so much. The stock goes up and up and up, making your put less and less, or more and more out of the money. Well, okay, that helps you some. Really, you need time decay to help you more, but we're going to talk about that in a minute. But if the underlying makes a big move down and it busts south of your strike, you can lose a lot really fast. That is negative gamma because you're short those options. So negative gamma is great when you own options and terrible when you're short options. Why wouldn't you always be long options? Well, I'm glad you asked. Because of something called time decay. Option prices decrease as time passes, all else held constant. Meaning if the underlying stock theoretically doesn't move at all, then you make money, or then options lose money as time passes. Now, this is a completely independent thing from delta. If the stock goes up, you make money on delta, but you still lose a little bit of money from time decay, or erosion, as it's also called. So, okay, intuitively, if I own an option, if I own anything, I don't want it to become worth less, right? If I own an option and there's a component of its price that decays in value, intuitively that hurts me. But if I'm short something, I want it to become worth less. I want it to decay in value. So this is basically, just a perfect trade-off for gamma. Long gamma helps, but short theta, negative theta hurts. If I'm long an option, gamma helps, but theta hurts. If I'm short an option, gamma hurts, but theta helps. Now, only extrinsic or time value decays. So if an option is in the money, the in the money component does not decay in value. Rules of thumb: near the money options have less decay initially and more as expiration approaches. And in fact, the closer we are to expiration, the higher that rate of time decay, which, very interesting, is still like the same thing I said with gamma, right? The more gamma helps, the more theta hurts. The more gamma hurts, the more theta helps. In the money and out of the money options have a more linear rate of time decay, and they have less time decay. So how do we measure this? Like, okay, great. We know options get worth less as time passes, but if it's just like a teeny bit, then who cares? But if it's a lot, then that's a big deal, either beneficially or detrimentally. So theta is what measures that. Theta is the rate of change of an option's value relative to the change in the time to expiration. That's very kind of textbooky speak. Basically, what that means is as one day passes, all else held constant, how much does the option decay in value? And that's measured in dollars and cents. If you were to see an option's theta, if it's like 0.04, that means it loses 4 cents as each day passes. Now, again, that's one isolated bucket of what affects an option's value. There's also delta, and there's other ones too that we're going to get to. All right, so this is all else held constant. Let's see here. Theta in practice. So I said what theta is as one day passes, how much do I lose as a result of time decay? Well, if it's 0.04, that's 4 cents. I lose 4 cents a day. But when exactly does that happen? When exactly do I lose that 4 cents a day? Is it at the very end of the day? Well, if you think about it, it can't be. That wouldn't make sense at all, would it? Because if stocks have just a little better than a 50-50 chance of going up than going down, and on any one given day, it's like really close to 50-50 statistically, a little better. But like what you would do is you would just sell options in the last second of the day and buy them back the next day. About 50% of the time you'll be right. About 50% of the time you're going to be wrong from a directional standpoint, but the theta would always end up in your pocket. So then if that was the case, then somebody who's really, really smart would say, oh, you know what? I'm going to actually sell these options a minute before everybody else so that I'm going to sell enough of them so that I push the price down, and then they sell them and it's not going to matter. They're selling them basically on tomorrow's days. And that is what we're going to talk about right now. Taking the day out. When exactly does that day get taken out? Well, what market makers do is they do something called gamma scalping. And that's a big, long explanation. I have a whole class on that. But they do something called gamma scalping. Basically, if they're long gamma, like long a bunch of options, they trade them delta neutral, they're going to lose because of time decay, but they're going to make money on scalping the gamma, because when the stock goes up, they have to sell shares to get back to delta neutral. When the stock goes down, they have to buy shares to get back to delta neutral. And if it goes back and forth, they're basically forced to scalp and make money on that gamma, which can offset the theta as long as it moves enough. But if it doesn't move enough, what the market makers will do is they'll just say, this doesn't look like it's going to work out. I'm going to sell these options now. How do I do that? Well, I'm just going to move the day ahead on my computer so that all my options become worth less by the amount of the theta, meaning their offers are lower than their competitors. And so it makes them more likely to be able to sell. And their bids are lower than their competitors. So any customers like me or you who sells options to the market, we're going to be selling at the other person's bid, not the person who is smart and took their day out early. So exactly when does the day come out? Well, the day comes out sometime between when the market opens and when the market closes. Usually sort of in the middle of the day. But with the weekend, there's 3 days because, you think about it, we have to use a 7-day calendar when it comes to option pricing because a stock can change in value over the weekend. Over some of the past weekends, we had a couple just crazy political events that, made the market fall. And basically, like on a Saturday or on a Sunday, traders and investors say, oh, well, this event, whether it's a political event or an event specific to that stock, oh, well, that event is going to make the stock worth less or more. If they announce that they cured cancer over the weekend, that stock's going to be higher and that affects the value of the options. So on a theoretical basis, we have to think of the value of options over the weekend. So we need a 7-day calendar. That means that there's 3 days of time decay over the weekend, Friday, Saturday, and Sunday. So we have to take the weekend out. So traders start taking the weekend out usually on Thursdays. And by the end of the day, Friday, a lot of times they're already trading on Monday's days, which, boy, I could go down a huge rabbit hole with this, talking about volatility. Those of you who are pretty sophisticated when it comes to volatility, you may have noticed that, well, you may or may not have noticed, I'll let you in on the big secret here, that implied volatility, or the VIX, tends to look lower on Fridays. If you went and did a study, Friday would be the lowest day of the week for the VIX. Why is that? Because volatility is not actually lower, but the option prices are, because market makers are taking the weekend out. Traders are taking the weekend out, which makes the options cheaper. And the option pricing models that don't change dates, all they recognize is, cheaper options must mean that volatility is cheaper. And if none of that makes sense, we're going to talk about volatility in just a second. Let's wrap up here, though, first with the gamma theta relationship. So again, gamma is the rate of change of an option's delta given a change in the price of the underlying. Well, gamma and theta have an inverse relationship, like I pointed out before. Basically, the best way to think about it is negative theta, like losing money every day on an option position, is the cost of the positive gamma benefit. Because remember, I said if you're long options, gamma helps you. You either make money at an increasing rate or lose it at a decreasing rate. Paying extra and losing money because of time decay is the cost of that benefit. Positive theta is compensation for negative gamma risk. Those of you who do a lot of credit spreads or cash secured puts, if you're good at it, it probably works out a lot more often than it doesn't work out. But every once in a while, you really have one of those kicks in the butt where, you have a small winner, great, small winner, great, small winner, great, small winner, great, big loser, right? Now, if you're good at managing your risk, hopefully that's more like small winner, small winner, small winner, small winner, small loser, small winner, small winner, small loser, small winner, small winner, big loser. You can't avoid them. They're going to happen sometimes, but why do we accept that disproportionate risk? Because we get positive theta. All right, now I promise you I was going to talk about volatility. Now's the time, folks. There's 2 types of volatility when it comes to option trading. One is realized volatility. That is the annualized standard deviation of an asset's prices. Ugh, geez Louise, what does that even mean? Well, basically, mathematically, they take the closing prices of the stock price over the last month, and they find the standard deviation of that, and then they annualize it to make that 1 month represent 1 year. They do that so it's standardized and they can compare apples to apples, different stocks, different time periods against each other. But okay, I mean, what does that even mean? If you haven't taken a statistics class, maybe you're not even sure what standard deviation really is. Well, look, all it is, you don't have to know. All you have to know is realized volatility is how much the stock has moved around lately. The bigger the number, the more it's moved around lately. The smaller the number, the less it's moved around lately. It is the annualized standard deviation, but that can just be thought of as trivia. Now, you might not be familiar with the term realized volatility. It's also called historical volatility, and it's probably more often called historical volatility than realized volatility. Some people even say statistical volatility or the stock volatility. Now, that's kind of the easy one. There's another one here called implied volatility. Now, implied volatility is this. Implied volatility is the volatility figured that when entered into an options pricing model yields a theoretical value reflecting current market prices. Geez Louise, that's another big mouthful there. Don't you hate these textbook definitions? Like, what does this really mean? Easy. It's just how cheap or expensive the options are, all else held constant. Yeah, we know stock goes up, calls make money, puts lose money, down, puts make money, calls lose money. Yeah, we know as time passes, options lose value, hurts longs, help shorts. But there's another factor, and that's volatility. It basically measures the supply and demand of options. Because look, if Goldman Sachs comes in and buys 10,000 of these calls today, and the stock doesn't go up or down today, those calls are going to go up in value. Why? Because supply and demand. They used to teach economics in high school, even grade school. They don't do that anymore. Those of you who had the benefit of learning about simple economics like this, it's really important stuff, especially if you're a trader. I think if you're anything in life, if you do anything in life, the more demand there is for something, the more expensive it has to get. It's not the theory of supply and demand, it's the law of supply and demand, because it has to work that way, right? So if Goldman Sachs comes in and buys 10,000 of these calls, they're going to get more expensive. That is what implied volatility is. If somebody comes in and sells 10,000 of these calls or puts, they're going to get cheaper because of supply and demand. Some people will say that this is the market's estimation of future volatility of an asset, and there is some truth to that, but that's a reason why somebody might think of that as a reason of why somebody bought or sold, but my real definition is a more exact definition. There's no council of elders that gets together and estimates what the future of volatility of an asset's going to be. Somebody goes in and buys a bunch of calls, implied volatility goes up. That's it. Maybe they were thinking about what the future volatility is going to be. To some degree, they probably were, because they wouldn't be buying calls that decay in value unless they thought the stock was going to go up a lot of volatility to the upside. So they are definitely related, but they're not directly related. Okay, so realized volatility is a mathematical measure of the past volatility of a stock or ETF or whatever. It looks backwards and takes the annualized standard deviation. It is the stock volatility. Where implied volatility is the volatility figure when entered into a pricing model that yields a theoretical value. Basically, it's forward-looking. It's the volatility implied by option prices. So when implied volatility rises, that means option prices are rising. When implied volatility falls, that means option prices are falling. And like I said, implied volatility is derived from the market, from decisions in the market, from supply and demand forces. Implied volatility is sometimes more important than directional moves. All right, so because we are always going to make or lose money based on other traders buying or selling these options that we are trading in, like, we can't just have that be some random event. We have to be able to forecast that and think about how much is this going to affect the value of my option. Because a way far out of the money option on a $10 stock that has a couple days till expiration, that's not going to affect the price of it much at all. But a 6-month option that's right at the money on a $500 stock, that's a 1 point change in implied volatility is going to change that a lot. So we need a measurement of how much a change in implied volatility affects the value of an option, and that is vega. Vega is the rate of change of an option value relative to a change in implied volatility, and that is measured in dollars and cents like theta. So basically what that says is if implied volatility goes up 1 percentage point and the vega is 7 cents, that means the option, call or put, will go up in value by 7 cents. And if implied volatility goes down 1% and the vega is 7 cents, that option, call or put, will go down in value by 7 cents. All right, makes sense? A couple of rules of thumb here, and I kind of alluded to some of these just a second ago. Long-term options have higher vega than short-term options. And if you think about it, that's because we're talking about volatility. More movement of the stock can occur in a year than can in 1 day. Just it's from a statistical standpoint, likelihood standpoint. So longer term options have higher vega. They're affected more by changes in implied volatility. Near the money options have higher vegas than in or out of the money options. All right, we've got one more Greek to talk about, and this is the black sheep of the family here. Nobody talks about rho, but rho has actually become important over the past, year or so, since interest rates have gone up. Actually, more than a year or so by now, I guess, since interest rates have gone up. Rho is the rate of change of an option value relative to a change in the interest rate. And the more time there is until expiration, the more the interest rate affects an option, right? If I invest my money at 5% for a day, I'm not going to make a lot of money. But if I invested at 5% for a year, I'm going to make 5%. That's an annual percentage rate, right? I'm going to make, for a day, I'm going to make 5% divided by 360. So long-term options are affected more by rho. And so why does rho exist? Let's just talk about that for a second. Like right now, this is kind of trivia, but I want you to be able to think about this in a smart way. If I buy 100 shares of a stock, let's go back to our $100 stock. Well, 100 shares times $100 is $10,000. That's how much it would cost me to buy that stock. Now I could just go and put my money in the bank and in a CD or treasury bond or something, treasury bill, T-note, and maybe I can make 5%. So that means whatever happens with that stock, remember I said you can think of equities as an investment, as an asset, and we can think of cash as an investment. Cash grows by 5% right now. Those of you who are watching this early August 2024, cash grows by about 5% right now. So if I'm tying up $10,000, that's my opportunity cost. I'm losing $500 of opportunity cost. But if I buy an at-the-money call for maybe $5, which is $500, right? Then I could take the rest of that money, the $9,500, and I can put that in the bank and earn 5% on that. So calls are worth more when the interest rate is higher because I don't tie up all that capital with. When the interest rate goes down, calls get worth less, and then it's just the opposite for puts. So something to think about. Okay, so let's talk about using the Greeks. We can use the Greeks for trade setups, for trade planning and expectations, for managing trades, for setting up our exit strategies, and there are many, 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 many techniques for all of those things, and it would take me, we could have another 3 classes on this, and maybe we will. So that being said, I'm going to open this up to Q&A. Before I do, one thing I want to do is if you have other friends or colleagues who trade options and you like the things that you're hearing here, tell them to come to Firstrade's website and sign up and watch these webinars that I'm doing. It's free to you. It's very useful information, I think, and can help you to become a better trader. It's a great resource. So spread the word. All right. What questions can I answer to help you make the decision? Or what questions can I answer at all, I guess? What questions do you have that I can answer? Anything that we talked about. Hit that questions box for me, will you? Jeff says, one thing I always find peculiar, who or what sets all these Greek values? Great question. Yeah, it's not like somebody just makes them up. So these are a product of the options pricing model. So like you've heard of the Black-Scholes model, probably, right? Even people who are not in option trading, many of them have heard of that. And if you haven't, well, now you have. So back in 1973, Fisher Black and Myron Scholes, a couple professors, were trying to figure out a model that could help them understand how option prices work. And they came up with what's generally accepted to be the first model, although apparently at around the same time, Edward Thorp was actually working on it independently, and they both apparently came up with a different but very, very, very similar models at the same time. Anyway, what that does is it takes the stock price, the strike price, time to expiration, interest rate, dividends if they pay dividends, and implied volatility, and it comes up with a theoretical value for the call at that strike, and then you can use it for the put at that strike, and then you can calculate it for different strikes, and then calculate it for different amounts of time to expiration. And so what ends up happening is, because you have these theoretical values, you can then use a mathematical formula that says, oh, well, if the underlying stock price changes, what does that do to the value of this, the theoretical value of this call that the pricing model created? So they're just sort of like, I don't know exactly what you call them, axioms, postulates of the options pricing model, spin-offs of the options pricing model. But, they're very, very specific formulas. There's one, there's the one for delta, there's one for theta, there's one for vega, etc. Very, very good question. Scott says, I heard that overall options tend to be overpriced and most options expire worthless. Does that mean that statistically it's better to sell options than to buy them? Yes and no. Like, statistically, it's hot in Chicago in the summer, but I don't know, tomorrow it's supposed to be chilly. So does that mean, like, if I'm going to a night baseball game, to a Cubs game at night, I should, wear shorts and a tank top because it's summer? Well, no, it might be cold. So I need to see what the forecast is and decide what to wear. And we do that with options too. You are correct that options tend to be statistically overpriced, but that's first of all, that's by a very small amount. And it's changed over time, but far less than 1% overpriced. But that's overall. That's, hey, it's hot in Chicago in the summer. You have to wear shorts all the time. We can use volatility analysis in order to know for sure if any given option at this specific moment that I'm about to trade it, if it's overpriced or underpriced. More often than not, it'll be overpriced, but sometimes it'll be underpriced. And that decision guides our decision as to whether to use option buying strategies or option selling strategies. Now, as far as whether they expire worthless, there's some debate on that. That was taken from the CME or Board of Trade's website. although the CBOE's website says something different. The reason for the disparity is that one of them doesn't take into account the fact that most options are actually closed between now and expiration. That's the majority of them. I think it's like the CBOE would say that 60 or 65% are closed between now and, from when they're open to expiration. And so then of the remainder of those, more expire worthless. Whereas the CME or Board of Trade's website doesn't take into account the ones that were closed and just says, it's expiration. Well, most of them are going to expire worthless. So they're basically both saying the same thing, but they're skipping the really, really important part that most options get closed. So yeah, a little caveat. Peter says, regarding trading IPOs, which Greeks would be most helpful or not? Well, trading IPOs is tricky because a lot of times on IPO day, the options don't exist. It's just the stock price. You're talking initial public offerings, right? It's just a stock. The options, a lot of the times, don't start until afterwards. But there are definitely times when options start trading day one of the IPO. And theta is going to be whatever theta is. As each day passes, that's that. And because it's an IPO, it doesn't change how time works. I would say probably the biggest thing would be delta, because you can get pretty big moves on IPO days, sometimes, not always. And then the next thing would be implied volatility, because there's no baseline for that. There are some stocks where their normal implied volatility is 14, but there are other stocks where their normal implied volatility is 32. And you don't know what that's going to be on an IPO day. So that one's a lot more of a wild card. Whew. Great questions. And boy, thank you for sticking it out and hanging in there and coming up with all those great questions. Like I said, please do me the favor, tell your friends to come and attend my webinars. Anonymous says, did you say a recording of this session is available on the Firstrade website? I believe it is. I'm an invited guest speaker here. I'm not, I don't work for Firstrade. So, Firstrade is typing an answer here. I'd actually like to see the answer so I can answer this better in the future, but I think the answer is yes. Let's see if I click on answered questions. The answer is yes. They are on the website. All right, that being said, have a great rest of your day. Trade smart, and I will see you next week.